Welcome to your beginner investment course of the crash course on how to invest in the stock market, where you will learn about how to educate yourself and how to get started investing in the stock market, and also in particular what the stock market is and how to hedge your portfolio so that if the market unexpectedly drops, your portfolio is not going to be crushed. Now, I will say that from my own experience, I think it's important for me to highlight that for me, I have a background as an economist. So that means I studied economics at university. So I had a fairly, basic understanding of what the stock market is about. And for those who don't understand, the stock market is basically you have the primary and secondary market. Where you have the primary market, you have maybe accredited investors, people who have money. Let's say there's a business that is privately owned and they want to raise funding, so they can reach out to a few or a bunch of other private investors to say, hey, do you want to invest X amount and then get this amount of shares? Now, then if that startup then gets to a point where they want to then raise funding in a public market, in other words, so that all the people, including retail investors like me, individuals, can have access to the shares, they can be able to buy those shares. Then they can then maybe approach big institutions like Goldman Sachs or JP Morgan to help them in the process to then list at the stock exchange. So if you are thinking of the US, we are talking about stock exchanges such as NASDAQ for mostly technology-focused stocks, and New York Stock Exchange. So there are quite a number of them. There's also Chicago Mercantile Exchange, mostly for commodities such as agricultural commodities. So a market in that regard, that would be a place where they make the shares available so that investors can then buy and sell shares. So in that process, that's how people then make money. If you buy, let's say, for example, you have a stock that is, let's say, named, they have ticker names, right? Let's say Google, for example, just as an example, it's listed, it's trading, let's say, at $100. And then if people bid it up, in other words, if it's bought out and then the price might fluctuate, it might go up to $200, or it might drop if people sell the shares. But the key thing there is that you can possibly make money or lose money, in the sense that if you are intending to buy and hold, let's say as a long-term focused investor, the key thing is you want to get in there knowing that without the fear and the panic to just say, okay, if it drops by 2 or 3%, you get out. So the key thing is you should have an emergency fund. In other words, for me, I like to have 6 to 12 months or even more worth of living expenses, so that when I'm investing for the long term. Now, that's the basics of what the stock market is about. So there are a lot of those publicly listed companies in the US, and you can think of Apple, Microsoft, there are a lot of them, but most of those stocks, some of them, they are not profitable. Some of them, they are losing money. So if you are investing in the US, it means that out of, let's say, the top 500 companies, there's an index that's basically a benchmark that tracks the publicly listed companies in the US in different sectors: retail sector, technology, semiconductor sector. So there are a bunch of them. So what then happens? Let's say there are 500 of them. The last time that I checked, there were 502, because there are some stocks that have Class A and Class B shares, for example, Google, but it's still one business in a sense, the difference being in the voting rights between the different classes of shares. So what that means is, let's say Google has 4% of that index, and Amazon has a percentage. Then at the end of the day, you will have a piece of exposure to that specific company. Now, those are indices. Now, if you want to buy shares for stocks that follow that index. For example, S&P 500, there's the NASDAQ that is focused on technology, semiconductor sector. Now, you then you can possibly do it through what is called an exchange traded fund. So you have companies such as Vanguard, BlackRock, and these companies, what they do is they have a fund managers who then created fund. In other words, they pull the funds from investors, institutional, retail investors, fund managers, pension fund managers, and then they buy those shares. In this particular case, let's say if they want to mimic the S&P 500 index, then they can then track the performance of that index such that if that index is adjusted, they can also adjust their portfolio. So you find that the performance of the S&P 500 index and the ETF that track the S&P 500, for example, SPY, that's the ticker name. I'm just giving an example. This is not investment advice. You'll find that the performance may be slightly different because then the fund manager charges some fees. Sometimes there is as little as 0.05%. So there are quite a number of them that cover specific sectors. Exchange traded funds can also be for commodities like gold. You find out that there are also exchange traded funds that track even individual stock. For example, for me, when I trade stocks in the stock market, I normally trade exchange traded funds that follow stocks like NVIDIA, for example, NVDX, NVDL. But the reason why I do that is that for my broker, when I buy those shares, right, I'm not charged because it's an ETF, right? But when I sell, right, then I get charged, let's say $4.95 if I buy and sell 100 shares. But also, they are cheaper than buying the original share. Because if I look at the price of NVIDIA today, you can see here that it was trading. Let me use trading view. Let me use trading view chart, and then I can just go here. You see that today it was trading. Currently, the market is closed, but right now it's $144.50. But if I look at ETF, exchange traded funds that track this, right? Let's say NVDL. Let me just search for it here, NVDL. You see that this ETF is leveraged. In other words, if NVIDIA goes up by 10%, it goes up by 20%. If it drops by 10%, it goes down by 20%. So it's very risky in that sense. You have to manage risk. So I think at the end of the day, the most important thing is that you must understand these things, right? So for me, when I'm investing, I want to buy the underlying stock. I don't want to buy the leveraged ETF that I trade. In other ways, because I want to buy the original stock in that particular sector that I will be, investing in. Now, how do you get started? The first thing is that, like I said, you have to understand how this stock, what is this publicly listed business doing? Do they provide services? For example, Amazon, if you want to buy books, you can buy books. They're also doing AI and all different things that services that they offer to clients. Now, the way that I look at it, I look at the management, who is the CEO, what is their track record, but I look at their financial statements to say, in terms of their balance sheet, do they have a lot of debt, right? Do they have free cash flows? In other words, if they were to pay off their long-term debt, are they able to do that? And how long will it take? Now, what is the economic outlook? And I look at what analysts who focus on those companies. These are people who spend time, who are experts in that field, and normally they are from big institutions. So they can upgrade or downgrade stocks. Sometimes it can go up and down. Now, the second point is that you really need to understand the valuation. So let's say today NVIDIA is trading at $145. But if you buy at 145, stocks have been shown to uh, usually fluctuate, go up and down. But if it's overvalued, usually it can reverse to its intrinsic value. That is maybe its fair value. So if that fair value, in other words, their cash flows, the prospects of the growth in that particular business is, and their earnings per share. Because what's happening is in the stock market, investors are forward looking. In other words, if I invest my money, I'm looking to say, well, probably this stock is going to grow by 50, 20, 34%. So if I'm right, I can be rewarded, because if the market then finds that stock that it is undervalued, there may be more buyers that can then potentially push the price up. So you are talking of big institutions that are coming in to buy for 100 million or even a billion, depending on the number of shares that are available. So that's how the prices, fluctuate depending on who are in control, the buyers and the sellers. Now, if I have, let's say, $1,000 that I want to invest, how would I invest in that? For me, I think the first thing is I would read books, understand what investing is about. How would I invest in that? This is not investment advice, but for me, after I have the necessary knowledge, I would just start off by looking at things that I use every day. For example, I am recording this on my MacBook, so there are companies that produce this. This is not a recommendation, but I'm just giving as an example. I have an iWatch, Apple Watch. That's another product. So I could then possibly go and do a deep dive of the things that I spoke about. So I would then choose a broker, in other words, that would allow me to buy and sell shares. In other words, there are quite a number of them, but I would look out for the broker that has um, fees that are lower, because each time that you're buying, if you're charged, let's say $10, and you're buying shares for $200, that means it reduces your potential return. So if you buy and sell, then the issue is that you can possibly lose money if the stock price doesn't go up. Now, another important thing is that now once I have the money in the brokerage account, I can then have access to buying securities or to invest. There are equities market, there are bonds market. Some people can buy commodities or forex. So equities, you are talking of individual stocks that can be different sectors. So if you are looking at the NASDAQ, you are looking at over, let's say, 4,000 publicly listed stocks. There are quite a number of them. Toronto Stock Exchange, there are different exchanges. But the key thing is to invest in things, at least in my opinion, that have prospect for growth, that are undervalued, so that if it then goes up, you can possibly make money. Now, if I have 1,000, I think for me, the first thing that I would do after educating myself is to just buy an ETF, right? Exchange traded fund that tracks the S&P 500 over the past um, many years. If you look at whether 30, 40 years, it has returned about an average of 10%. And you will be quite shocked that a lot of even hedge funds, a lot of people, they don't even beat the S&P 500. So I would put maybe let's say I would buy ETF that track the S&P 500, maybe 40% of it, let's say $400. How do I buy that? There are different exchange traded funds that follow that. And I have covered some of them on this channel. You can look at different exchange traded funds, not as recommendation, but just to educate you, to say these are the things that you should consider looking at with managing that ETF. Which fund are they reputable? Where are they registered? So that's one thing. And then I would look for other individual stocks that are really undervalued. So I will show you how I would go about it in a minute. So this usually takes time for me, but I'm just going to give you an example. Let's say we are talking of, as an example, I have Palantir here, right? This is a stock that is very interesting, because if I look at their profile here, you can see what they do. And I use this website called Stock Analysis. There's the free version, but you see that this stock is currently trading at $71.85. Now, if I look at the historical performance, this stock at the beginning, um, let's say I'm looking at for this month alone, right? This stock, you can see October, it was around uh, less than 60. Let's see here. Let's see. This is just for a day. Okay. So let me just do Palantir. Let me use the this one, trading view chart, because that one sometimes if you don't have a paid account, sometimes it's more, it's like it's ex it doesn't work. So let me say Palantir. Let me just use Google. So if you look at year to date, you see that it has gone up by 338. This is not investment advice. I'm just giving you an example. So this stock, you can see that if you had bought this stock at $20, your money will have increased by 338. But the question is, how do you know that this stock is going to go up? Nobody can really tell confidently, but what I do is that I then look at some statistics to say what are analysts saying. But for me, I think, like I highlighted, the first thing is I look at their historical performance to say, are they profitable? Right? For sure, there are softwares like this platform. You go, it's free. You see here, they are, they are profitable, right? You can see here that they have gross profit, operating income. But for me, my interest, like I indicated, I want to look at the long-term debt, right? So you see here, this stock does not have debt, zero debt at all, right? But at some point, they had 197, 198 million. Now, in terms of their free cash flows, I want to know if they have free cash flows. In other words, they have money that they can deploy to other things. But I like to look at the trend. So you will see here that their free cash flows here were negative. In other words, they were paying out more money that way more money was getting out of the business. Maybe they were expanding, and which usually happens if stocks businesses are still growing fast. But now you see that the stock has been generating a lot of cash flows, 980, almost $1 billion in free cash flow. If you look at this, like as of September, they had this uh, amount of cash in their balance sheet. So for me, once I see that, I'm like, aha, this is very interesting. Now, what are analysts, these people who spend time understanding these stocks? What are they saying? Some are saying, oh, this stock might crash to this, but the average is 36. But right now, the high is $75. That's what they are forecasting. Again, people can be correct or incorrect, but at least these people, they use different models to analyze. And at the end of the day, free cash flow model, they use different models. But for me, I think I kind of want to have an idea. But if I then look at other metrics, there are quite a number of metrics. But for me, like I said, I have a background in economics, but I also love these things. So I research these things, right? So you will see that if I look at the kind of deals that are really happening, these are 390 million. These are kind of deals that they are closing. So if you look at it here, they've been closing quite a number of deals here, over a million, over 10 million, right? Over 10 million, 79 million. So these are contracts that they are making. So in other words, this is money that is coming in. So there are some things that are really, really happening in this particular stock, right? But at the end of the day, I think a lot of people, they make the mistake that if a stock has been performing well like this, then they believe that, oh, probably this stock is going to continue going up. So that's where understanding valuation comes in, because now you need to use different models to kind of understand, to say, with these free cash flows, do I think at $75 it is overvalued or undervalued. So if I believe it's overvalued, then that may not be the good time to buy. But the good thing is, there may be other stocks, other businesses that may be undervalued. So that's where it is very, very important to then spend time researching about companies, going through this and going even further to look at what are called 10F and look at their reports. In other words, you go on the Security Exchange Commission website, you look at these businesses, like because they are publicly listed, they're supposed to update and information if there are shares that are sold by insiders, if there are deals or things that may potentially affect the price of that stock. Because sometimes news, if people find out that maybe insiders are selling, they might say, oh, well, these guys, maybe they know that this stock does not, maybe is having some other, challenges, because the market is forward looking. So that's how I would go about it. So I like to only invest not more than 5% in one individual stock. But if that stock goes up, usually that position might then increase in terms of the percentage of the portfolio. But most of my money, as an example, is invested in exchange traded funds that track the S&P 500. So that means I will have exposure to the top 500 companies. Why do I do that? Is because most of the time, most investors, they don't beat the S&P 500. So if, let's say, 90% of them, they don't beat it, if I invest in the S&P 500, I can, at least from the past data, which is not a guarantee for the future prospects, but at least it's a story. I can beat, I can be in the top 10% in that regard. Then if I have individual companies that are really undervalued and then they grow by more than the S&P 500, because within the S&P 500, for example, index or the NASDAQ, there are some stocks that may not be doing well. So those stocks, they may pull the average down. So depending on if more stocks, let's say out of 100 stocks in the NASDAQ, right, for example, 60% of those, they grow by, let's say, 70%, right, as an average. And those that drop, they drop maybe by 10%. So the average still will be higher, as an example, because at the end of the day, if they have equal weighting, then still overall, that stock over time, let's say in a year or 6 months or 2 years, it will go up. Now, the interesting thing about investing is that not every time that you may be right, because you can be wrong. For example, you can believe that this stock is going to go up and then something happens. There's a hit story. For example, SMCI, for example, there was a hit story that their financial accounts were not really that great in terms of how they were audited, how they were internal controls in terms of their finances. But at the end of the day, they managed to weather that storm. And right now, even though it dropped to about $20, right now, SMCI stock, which produces semiconductor products, just like in the sectors like where NVIDIA is, it has really gone up. The last time that I checked, it had gone past $40 the last time that I checked. But stocks can really go up and down. And I can check right now so that you have an idea of what I'm talking about, SMCI stock. So if you look at this stock, let's just look at year to date, but you see that this stock around November 14, it really dropped to $18. But if you look at the news, there was a lot that it might be delisted. But then now this stock has been going up now that they've resolved the issue of the fraud. But what happens is that because people now want a stock, in other words, a stock fundamentally it's a business, right? There's a business behind every stock that you see, and they have a ticker name. In other words, that's more like if you're traveling, the airports have codes. So if you want to go from Vancouver, you type out YVR, Vancouver, to, let's say, um, LA, Los Angeles airport, right? So you look for that so that you can look for the connecting flight from Vancouver to Los Angeles, or if you're in Zimbabwe, Harare to Johannesburg, or Cape Town. So that's the same. If you are looking for stocks, you have to look for a ticker name. If you just type out the name of the business, let's say Palantir, you see PLTR. Tesla, maybe you see TSLA. So that's the ticker name. And then that's how you can find that particular stock when you go in your brokerage account. In other words, so that let's say you want to buy a stock, then you can then choose buy or sell. Now, as an investor, you are talking about buying and holding. So a lot of people, they confuse trading and investing. When I'm investing, that means I'm buying with the intention to hold. So I've spoken about how to educate yourself, how to identify companies that you may want to invest in. Mostly, I like to look at things that I am using every day, the local economy. Like, for example, if I'm driving or if I'm in a public transport and I see um, something that is interesting, I say, oh, is this business publicly listed? Then I look, I do my research, right? There's internet, then I take time, I research, I try to understand their free cash flows, like the same process that I explained to you. Then I can then say, oh, probably maybe if it's publicly listed, I'm gonna allocate 5% if I believe it's undervalued. I may be right, I may be wrong, but at the end of the day, what I look at is like the major indices. For example, right now, S&P 500, NASDAQ, most equities, securities, they've been going up. So usually stocks don't always go up. So that's when issue of risk management comes. So some people, they hold cash depending on where, like when you want to withdraw your money, some people, they have treasury bills, let's say for a yield of, let's say, 5%. So that means if you have 10,000 at the end of the year, you get that $10,000 plus 5% in that regard. So you get your 10,500 back, right? 10,000 plus 500 if it's the 5% for that, 250 in that regard. So if it's 10%, but usually let's say it's 5% or whatever percentage. So that's another way. So now I'm talking about portfolio allocation. So you can have equities. Some people, they have bonds because there is what is called the portfolio asset portfolio theory, that where investors believe, people believe that if you are, let's say, 60 years old, they believe that you can put 60% in equities and then 40% in bonds, because bonds and stocks, they have been shown to move in opposite direction. For example, if the equities or the stock market, it drops, right, you see that bonds prices might go up because people may then go to gold, cash, and then probably bonds. And that demand, people start to buy, and they may bid the prices up, might drive the price up potentially. But again, everything has nuances. Those are things that can happen. It could be because maybe there's something unknown, like the COVID pandemic epidemic happened. There was the interest rate jacking, like increasing interest rates, because it increases the cost of borrowing. So those are macroeconomic issues. There can be geopolitical tensions, like what was happening in the Middle East, Israel, Iran, and all these other tension. Why? Because people are forward looking, because they may be saying, oh, this conflict might escalate and it might increase the cost of petroleum or gas. And since in the production process, people, businesses may use gas and energy to run their businesses, it might then result in the increase in prices. Or maybe the talk of tariffs, like what's happening in the US with the incoming President Trump, to say maybe they may want to levy tariffs, 25% tariffs to Canada or other countries. So what that means is the cost of those of doing business might be higher, because let's say if you're importing a car from China and then it was costing $100, and if there's a tariff, it means they charge 25%. So that will be an extra $25. So that means if it was $100, 100,000, for example, it will be 125,000 for you to have, that will be the cost for you to have that car. And of course, there are many other costs, shipping and stuff. I'm just giving this as an example. So, but in terms of the local industries, those businesses in that particular country that may be levying tariffs, right? For example, in the case of the United States, we have, Chrysler, you have Tesla, you have other companies, they may then benefit from that. But it's very debatable in economics, because you have to look at the cost benefit in the net impact, because what if that particular business also uh, does the same? So there may be a trade war, and because you have companies such as Apple, Tesla, the factories in China, for example, what that means is that might also be potentially problematic. So at the end of the day, it's really, really hard to predict what's going to happen. But, analysts, they do that, they model, they use provision for error, but at the end of the day, for me, it's too complicated to really predict where the market goes. But I like to be conservative in my portfolio allocation. So I want to have a small portion of my portfolio in equities, but also I want to have some cash. But because I've observed that each time the market drops, the VIX, the volatility index, usually spikes. It goes up as people panic and sell off, and this has happened again and again. So I like to have an exposure to some exchange traded funds that have exposure to the VIX index, right? And this is not investment advice. I'm just sharing with you how to invest. So notice that I spoke about the having a brokerage account, understanding securities that you invest, but also having a diversified, but also rebalancing your portfolio as time goes on. If you want individual companies, then make sure that you don't, in my case, I don't want to invest all my money in one stock. Let's say if it is declared bankrupt, I just gave an example of SMCI. It can happen to any stock potentially, but that's where doing research and constantly monitoring what's going in the stock market, which for some people, because they have work, they have families, they have other things that may be happening, they may not have that time. So I hope these insights, may help you kind of like have an idea of what investing is all about. At least in my view, investing for me, when I'm investing, I want to invest my money to grow. It also depends on the stage of life which a person may be. Some people may be at a stage where they want the money to grow, they have other income streams coming from work. But some people, let's say, they are at a point where they are retiring. So they may consider maybe putting more money in dividend focused income streams where they get situations in that particular stock. So when you are investing, as simply as possible. You want to understand things that you're investing in. You want to do your own research. If you don't understand how to research, you can reach out to people like me to do research for you and to just give you some insights, what I think. But also some people, they just go to the bank. They are financial advisors. They are paid to do that. That's what they do all the time. But of course, they charge a fee. In Canada, for example, people get charged, I think, 4%, or it depends on what particular financial institution, and if they can provide value in that regard, make sure that you have an idea of their past performance and protect your money. So I hope this video helps you to kind of have an idea of what investing is about. And at the end of the day, it's your money. You must be careful, invest and trade wisely. If you have any questions, feel free to reach out to me via streetwiseeconomics.com. And also don't forget to subscribe so that I will share more content about how to invest in the stock market. I also share content about how to trade in the stock market. May the markets be on your side, and bye-bye for now. If you have any questions, be sure to subscribe, click, and comment on and below this video so that I can get back to you as soon as I can. Bye-bye for now, and I hope you'll be able to make money, grow wealth, and be in a stronger financial position. Thank you.